Real estate investing has a big difference with the stock market, liquidity, and time horizon. If you mess up an investment in a stock, you can sell and move on. However, if you mess up an investment in real estate, it's gonna take time, money, and headaches to get away from that property. Here you have the tutorial with the 5 basic steps to start investing in real estate. 1. Understand why you are deciding to invest in real estate. Do you want to buy your new home? If that's the case, why not rent it? Do you want to build equity in the property? This means that over time the value of your investment will grow once you pay the cost of the property to the lender, if you have one. Do you want to build cash flow? This means that the income you receive by renting the property will be greater than the cost of mortgage payments plus taxes and other expenses. 2. Where do you want to buy? Location is the single most important factor to a good real estate investment. You can remodel the property, change its floor, ceiling, and make it look better, but you can't change its location. And even if the location improves, that will take many years. For this reason, it is better to buy an okay property in a great location than a great property in an okay location. My advice is always buy something you would feel comfortable using and owning for more than 10 years. Location is related to the income of the zone, the services, security, schools nearby, among other topics. Please, if you are enjoying this content, hit the like button, subscribe, and tell me in the comments which content do you like to see here. 3. What is your budget? In this case, this answer will depend on the reason you are buying. It's not going to be the same buying your first, second, or third property. If it's your first and you want to move, probably you can be more flexible towards the amount of money you could invest. But if you are doing it for building equity or cash flow, probably you will want to use an amount of money that will not put your finances in danger. You also need to consider your total portfolio distribution. How much do you have in the stock market, in crypto, in real estate? 4. How are you financing the property? This refers to how much you are putting in the down payment versus the loan. It's common to get a 30-year fixed mortgage. However, this may not always be the best scenario. You need to calculate how much you are going to pay interest for how long, inflation rate of your country, among other topics. In this case, the lower the interest rate and the bigger the down payment tends to be the good approach. 40% down payment tends to be a good starting point. I know it sounds like a lot, but we don't want to pay 3 times the cost of the property to our bank. Sometimes it is better to pay rent and invest the capital in other places until we have that 40% down payment. 5. Timing is key. Remember that these investments are long-term, hence, the moment of the investment is super important. We want to buy when there is a real opportunity and a good margin of safety to pay that big check. This has to do with how the overall market is looking in terms of renting the property, interest rates, price trends. If you haven't already, hit that subscribe and like button to support this content. I'll see you later, Wall Street Gods.